Welcome to the Thematic Investors podcast, powered by Vidrio Financial. Vidrio Financial is proud to support the Thematic Investors podcast with host Kieran Cavanna. Vidrio helps allocators harness the investment complexity to make better allocation decisions. Learn more at vidrio.com. That's VIDRIO.com.
Welcome to the Thematic Investors podcast. I am your host, Kieran Cavanna of Old Farm Partners. Our goal is to bring great investors and themes that great investors are working on. Some are under the radar, and we think they're experts in their disciplines. This podcast series is sponsored by Vidrio Financial. Lucky for us today, we have one of the best telecom investors in the U.S. to talk about what's going on in that sector. And we're not talking about the old telecom business. It's the days of AI, semiconductors, data centers, cell phones, and video delivery. Arguably one of the most dynamic areas in investing. So welcome Alan Bezoza of DigitalBridge.
Thank you, Kieran. Nice to meet you, and thanks for having me on.
Alan is uniquely qualified to talk about what's going on in the telecom sector. Since October 2020, he has managed a low net, low factor, long short equity strategy out of Denver. Alan has been investing for 20 years in the global telecom and cloud ecosystem. He manages a strategy inside a publicly traded global alternative asset manager, DigitalBridge, which is one of the largest owners and operators of digital infrastructure. As you'll hear, we think this is one of the most dynamic areas for investing. So let's kick it off. So Alan, I'd love to hear a little bit about your background and how you became so enamored of the telecom sector and how it all works.
Well, thanks, Kieran. And first, let me just say you make telecom sound sexy, so thank you. To start off, both my parents were engineers in Bell Labs. I grew up in New Jersey, near the beach, Seaside Heights, Tom's River, if you know that area. And a lot of people in that area, their families all worked at Bell Labs at one point in their careers. And so I'm the prodigy of two engineers. My father was in optical networking, and my mother was on wireless technologies. And so growing up, I would hear all these stories about my dad and telling me stories about the things he's working on. As I tell my kids today that their grandfather was an important element in making the internet work. There's things like DWDM technology or CDMA in my mother's world. These are two really important technologies that were invented and refined in Bell Labs. So I'm really proud of the work they've done. They have now retired since then, and their level of technology has ended with the day they retired. So our conversations are much different. But growing up, we talked a lot around the Thanksgiving dinner about what was going on in telecom and how it all worked. I guess generally speaking, if I go back to my career and my history, I've always wanted to know how things worked. I would take apart stereos. I would take apart anything I can get my hands on and take it apart and figure out how it worked. It was always amazing to me, and just putting things back together and try to get it to work again. I built remote control airplanes with my dad, just all kinds of stuff. So that's kind of like, I've always had this sense of intellectual curiosity that when I first started doing investing in the late 90s, I actually worked in the aerospace defense industry. And my father was actually in the Air Force prior to working at Bell Labs. And so we always had this affinity for talking about airplanes, and during the idea that technology was becoming more and more important for aerospace defense. So in the late 90s, I had an opportunity to start looking at the industry of communications technology, optical networking, which was this exact same spot my father was at Bell Labs. So we started, it just was a fantastic time in the world. I mean, the internet was just growing, and it couldn't grow without optical networking technologies. And that's where I started. And over time, I expanded from the center of being comm equipment, let's call it, and went upstream to do carriers, data centers, telecom companies, media companies, as well as downstream to do semiconductors and the supply chain underneath it. So my frame of reference and my lens for many years has always been up and down this large food chain. And I'd love to know how this works. And by knowing how it all works at the very beginning, it gave me a lot of insight in how to invest across the telecom space. Cable versus telecom in the late 90s for broadband. DSL versus cable modems was an early theme that was certainly questionable by investors who was going to win. Now we have the same issues with wireless versus wireline. We can talk about that later. But there's so many things that are happening and always happen in this space that makes it interesting, and it's an important part of our daily lives. So I'm a tech nerd by trade, and I love applying technology to investing.
Well, you could have just said you owe it all to your parents, I guess, but it's always fascinating to me. I mean, I do think you could do a whole podcast on the parents of great investors, but But before we establish what you're a great investor, I'd love to walk through with you a little bit more on, where we are today. A lot of people look at TMT, the sector that includes telecom, media, technology, or technology, media, telecom, I guess. And you focus very much on the telecom side. So maybe we could break it up a little bit and tell us where we are in the cloud ecosystem, and then we can get into the telecom system. And there's so many competing technologies, so many things to do. It does make sense to me that a long short equity strategy might find good longs and good shorts when they're incumbents and then they're challengers. But maybe we could start out with the cloud ecosystem from your perspective.
My gosh, that's a mouthful of a question. So the cloud ecosystem includes all the third-party cloud providers like Amazon, Microsoft, Google, et cetera. Then there's people like Facebook that build clouds for themselves, and Apple as well, where they're building their own clouds to handle their own applications. Google is kind of in the middle there. But generally speaking, what's happening right now is something I haven't seen in a long, long time. The demand for both power, for space, and for connectivity has just grown in different vectors at the same time, all at the same time. And it's obviously driven by just more things going into a centralized location, more things going into the cloud, quote unquote. But at the same time, this whole shift to AI is driving a lot of change as well. Companies like Microsoft, Amazon, and Google have been spending an immense amount of CapEx over the last 3 to 5 years, ever since COVID, really, where things just took off. The cloud got bigger and more important. All these applications, even a Zoom call, is going through the cloud, right? It's not me calling you and going switch to switch. It's going through the cloud and the cloud back to you. So what's ended up happening is the COVID and work from home changed everything and accelerated the demand for data centers. Hasn't changed. It's actually gotten more and more stuff over the last 3 years. And now we have this AI wave that started at the end of last year where Microsoft, Google, Amazon, and Facebook even have just accelerated their planning and spending to build and construct data centers for next generation architectures. There's an immense amount of change. And it's something that, when I sit here and I write these quarterly letters to our investors, I look back at some of the ones I've written and it is literally mind numbing at how things have changed and how quickly they've changed. And I'm happy to go through all the details, but space, power, which is the big part, and connectivity, you cannot underestimate the need. Insatiable stuff.
I mean, it's extraordinary, right? I mean, I just looked at Amazon's AWS did 80 billion in revenue last year, and it's more this year. And I didn't know what AWS was 3 years ago. So, I mean, maybe you could follow up a little bit on that, on how things are changing from what, I think most people think how data centers work. And then maybe a little bit on that power issue, because I don't think I've heard too much about how much power we're going to use. I've heard that, we keep hearing everything through the lens of semiconductors in my world, the investing world, and how much there's such competition for NVIDIA chips. But I guess everything else around it must be changing as well. So maybe you could just walk through a little bit of that.
Yeah, let's start by the premise. So my firm, DigitalBridge, is a asset manager that specializes mostly in private equity. We're obviously on the public equity side, but we're a private equity firm that specializes in data centers, towers, and comm infrastructure, or comm networks. And if you think about data centers, which is a big part of our practice, these are massive buildings that we build and construct, cool and give power, and sell space and power really to Microsoft, Amazon, Google, TikTok, Oracle, et cetera. So what ended up happening is, Microsoft used to build their own data centers. There's been a shift over the last 5 years because they can't build them fast enough themselves, and they don't have the land, they don't have the power capabilities or the people to be able to build, construct, design, and implement these data centers. So what they're doing is they're basically using firms like our portfolio companies, like Vantage and DataBank, and building out these data centers. Now, it takes 3 years to build a data center. I can't say that again. I will say it again. It takes 3 years to build a data center. You can't rush it. It's not like building another manufacturing line in the semiconductor space. And that's why, to your point, people look at the lens of semiconductors, don't understand power. The power supply chain is really a problem. We just can't build power fast enough. And at the same time, we actually can't transport power that well. You can transport data with fiber optic lines. We've been doing that for 50 years. But what we haven't done is transport power well. And so you have to build these data centers in these power zones. So Northern Virginia has become a very large power zone, I call it, where there's connectivity between New York as well as Europe, but there's a lot of power availability there. And so it became this critical mass. There's other areas too around the world, San Francisco area, Bay Area, LA, Dallas, Frankfurt, Amsterdam, etc., where these big power zones or data center zones have been built. If you fly over to Dulles, you'll fly over just data center after data center after data center and outside of Washington, D.C. So what's ended up happening is that the amount of space and power is being limited by just the amount of we've already built. So in order to find cheaper power to be able to provide these AI chips, and we talk about NVIDIA chips being very power intensive relative to the CPU Intel counterparts. But as we move to AI, it's not a space problem. It's actually a power problem. And these GPUs, and it's been really well documented, how much more power hungry they are than their predecessors. Yes, they're more efficient and generate more compute technology, but the power required, actually physical power, is going to be a challenge and probably a bottleneck. So what we're doing is, because it takes 3 years to build a data center, we're actually moving a lot of these data centers out of those Northern Virginia power zones, as I called it, and moving into places where there's cheap power, places like Iceland, places like Scandinavia in general, Northern Pacific Northwest United States. These are areas where there's cheap power, and you can still transport the information via fiber optic cables, and you're still close enough where you don't have latency issues. So that is kind of the issue we're dealing with right now, is that the power hungriness of these GPU servers are just multiples more power hungry. So originally we built these data centers with a certain framework of how much square footage per watt. And now, because there's more wattage being needed by these GPUs from NVIDIA, we only need about 13% of the space for the same amount of power. So we don't have a space problem, we have a power problem. And when you take a legacy data center and try to retrofit it into a GPU from a CPU-based data center, it falls off a cliff, the economics, because you're only using 13% of the space, being a 6 times more power hungry. So there's a lot of change happening. And so we're now, and this is really all because we're taking 3 years to build a data center. The designs are doing today for AI, the last, let's call it 9 months it's all started, are really not going to be implemented for 3 more years. So all the data centers coming online today are not efficient for today's architecture of these GPU clusters that they're building. So I know I threw a lot out there to you, and maybe I'll breathe and let you ask a question.
No, it's very cool. I mean, I think
the change happening is location, the size versus power, or the space versus power conundrum. And then also, how do you figure out these legacy data centers and repurpose them when there's no power per square footage is off?
Well, I think it's fascinating. I mean, I promised my partners I wouldn't mention uranium or nuclear power, but it seems like it would be part of the solution here. But we could that could also be for another podcast. But maybe you could talk about in this sort of extraordinary build out. I mean, it's an amazing thing. It's all emanating from the U.S. too, and the hyperscalers, the big ones. Maybe you could talk about what the strategic priorities are for those hyperscalers.
It's very interesting, because each one of the hyperscalers, I wrote in one of my quarterly letters about Cloud Wars. So there's Cloud Wars 1.0, which was basically providing third-party workloads for banks, for retailers like Home Depot, Walmart. Everyone moved to the cloud, right? Even companies like DigitalBridge run in the cloud with Microsoft. So everyone moved to the cloud, and in Cloud Wars 1.0, Amazon won. Amazon won Cloud Wars 1.0 because of the fact that they created APIs and integration to easily port over workloads from on-premise to off-premise, right? And they provided all this support and, like I said, API connectivity. Microsoft had their own Office 365 ambitions, and Google really tried hard with Google Cloud, GCP, but really never took off the way that Amazon did. So Amazon won Cloud War 1.0. Here we are now in Cloud Wars 2.0, as I call it, which is now the AI business. AI is going to create it's very expensive. The CapEx required is immense, partly because these GPUs and the actual power required, but also the GPUs themselves are much more expensive. So it's very capital intensive. And so if anyone without scale, other than the cloud guys, want to create workloads on AI workloads, they really have to be on the cloud. So what's end up happening is that the cloud guys in Cloud Wars 2.0 is very different. Nobody wants to be left behind and let Amazon win. So what's Microsoft doing? Microsoft has their own internal based systems for AI workloads, meaning that they're creating Copilot, which is going to make our lives more efficient. Excel, Word, building and coding, doing things with pictures we've never done before. So all the things that we could be more productivity in AI in Microsoft's suite of products in Copilot is what they're building towards. And so by doing that, they're charging people $30 more a month for their products. I'm looking forward to get my hands on it and see how I can be more effective and efficient. I probably would have had a much easier day today. But nonetheless, that's kind of their strategy. They're spending all this money on NVIDIA chipsets and building out these clusters so they can create Copilot to make everyone more efficient and charge people more money. Of all the actual cloud providers, they have the easiest path to making more money because for $360 a year, of course, my firm is going to pay for all us heavy Excel users to have the product. Of course, they're going to pay for companies around the world are going to pay $360 more dollars a year. It's a rounding error, right? So that will likely stick, and that's a big revenue opportunity for Microsoft. So what are they doing? They're spending a lot of money, right? Their capex has gone from like 28 billion to somewhere in the mid 40s next year. That's a big jump up in capex, right? Now let's talk about Google. Google, what they're trying to do is they're trying to improve their search capabilities. So I don't know if you've used Google's new AI search capabilities, but you can actually implement it into your search engine. It's a setting. I'm happy to show it to you afterwards. But basically, every time you search now, it's called Google GME, I believe it's called. But you can have their algorithm will show you kind of the same ChatGPT type information on the very top of the page before they have the search into clicking into different things for advertising-based purposes. Their goal as a company is to improve the search algorithms to get higher CPMs using AI. Right? They've already implemented AI. I think people are missing this on Google is that they already use AI in a lot of their search algorithms on YouTube and in just general search. It's not a new thing for them. They've worked in AI for many years. I think the view 6 months ago is Google's behind. They just have a different strategy. They're not trying to provide third-party workloads for companies providing AI. They're using AI for their own search algorithms to get higher, better search, better CPMs. And then you go to Amazon, and it's probably a little less clear, a little more cloudy, to use a pun. But I think their strategy would be similar to do what they've done in the Cloud Wars 1.0, which is to offer AI workloads for third-party consumption, meaning Home Depot, Walmart, all these companies, can they move towards Amazon's cloud and run AI workloads there rather than working it on-prem? So to be a third-party host for AI workloads. That seems to be the Amazon strategy as of now. I have the right to reserve to change my mind. But this is so expensive because these AI clusters, these GPU clusters are so expensive. We're talking about $25,000 per cluster. And, we're talking about needs of billions. I mean, the numbers from NVIDIA are massive. And so only a few people can afford to do that. Companies like Bloomberg are actually taking down data center space right now in order to do some AI stuff. Not unclear what they're doing, but we know they're taking down space in different markets. Companies like JP Morgan and Goldman Sachs, these very large banks, probably have the capital necessary to build and construct and play with AI workloads. But right now, very few companies have the ability to spend the same amount of money that is required that the big guys are doing.
That it is one of the coolest areas to invest, and you lay out a really interesting scenario. But what about NVIDIA? And that's actually caught everyone's attention. What about this kind of explosive growth? What are you seeing?
Yeah, I mean, clearly NVIDIA is in a pole position right now for designing and developing GPU clusters that are used in AI workloads. Others like AMD, even internally designed systems from Microsoft, Amazon, Apple has a big project, as well as Google, all have internally designed process in place to be able to circumvent NVIDIA. However, right now, NVIDIA is in a pole position with really the only game in town, providing both the software stack, the chips, as well as the connectivity through InfiniBand to be able to make this all work. So they're selling a bundled product, and because of the allocations that are going on right now, they're selling a lot of these bundles versus stripped down GPUs. However, one of the things that I've been thinking about, I haven't really been able to quantify this exactly, but just noodling over this. We wrote about this in my recent quarterly letter as well, that the estimates for NVIDIA for next year, 2024, is roughly $40 billion, plus or minus. This is in the data center segment. I'm sorry, is roughly $60 billion. If we assume about $45 billion of it, or most of the incremental growth is coming from GPU clusters, this translates at $25,000 per GPU cluster translates to about 1.8 million clusters or servers to be delivered in 2024. It's a big number, right? And the numbers out there are massive, right? They're massive growth, big, big, big. However, each server uses about 10 kilowatts of power. And so the problem with that is that given the cost structure, these engineers want to run these things as hot as possible with zero downtime, which is theoretically impossible, but they want to run it hot. And by utilizing this at a high rate of utilization and doing some math behind it, you basically come that these 1.8 million servers will consume about 2.3 gigawatts of power, incremental power. Talking. Now the whole industry. Now this is just GPUs, by the way. This doesn't include networking, storage, cooling equipment, other things that are installed alongside the GPU cluster. But to put this in perspective, the entire US data center market is expected to grow by 2 gigawatts per year. So these new GPUs, clusters from Vidrio, are going to utilize all the data center power capacity coming online over next year. Wow. Now, again, I told you it takes 3 years to build a data center. So the one question I asked myself, and I've been thinking about it, is where are all these GPUs going to go? Yes, the semiconductor analysts can estimate X, but the data center analyst, which is 3 steps removed from the semiconductor analyst, can't build any faster. It just laws of physics. You have to create power. There's zoning, there's labor. It's not turning up a manufacturing line. So one of the things I've been yes, there's this great demand of GPU clusters right now, but I just don't see how these can actually go anywhere. At some point, this is going to have a hard time, or Nvidia's going to have a hard time with the incremental demand, given the fact that there's going to be people sitting on supply. And this is always a problem when we have semiconductors and we have supply-demand imbalances, right? When there's supply chain restrictions or constraints, they ultimately always end up in gluts. I don't think I've ever seen it not become a glut at some point.
It's any big moves like this will always have fits and starts, right? And I guess it's a great question on how it's not going to be linear.
And the problem with this, sorry to interrupt you, but the problem with this too is that you have things like, I told you, Microsoft has an insatiable amount of demand right now because of its Copilot opportunity. But you have people that are buying these GPU chipsets, these GPU clusters, without a real path to revenue. You know, the government of Saudi and other Middle Eastern countries have been buying AI GPU clusters from NVIDIA too, for like a skunkwork project. I'm sure our government's buying the same, but you have lots of companies that are out trying to figure out, what does AI mean to me? Not everybody has a clear path. And so it's creating a lot of excess demand of this fear of missing out. Like I said, Microsoft is probably one of the few companies that have a really clear path to be able to monetize AI in these AI clusters and spending all the money they are. But there's a lot of question marks around lots of other companies, even Google included, actually, and Amazon. You know, can they get better search algorithms and better CPMs by spending more money on AI workloads? It's unclear. But there's lots of companies that have said, like Bloomberg and others, buying GPU clusters for like a skunkwork project to see if they can make AI mean something to them.
It's worth it for them.
We're in a very weird situation right now, and it's always something that I always think about the semiconductor and the data center analysts. They don't really talk.
Well, maybe it's for, again, the liberal arts majors that are like myself, we could switch to telecom because, we are just bombarded as consumers with, cable companies going into phone business and phones going into the cable, and I don't fix wireless. It's something, it's a new concept to me, actually, and I'm sure that sounds naive to you, but I would love to understand telecom, and could you set the stage for where we are right now and what's going on?
So in terms of telecom, I've been covering this space for well too long to tell you about 25 years. And when I first started, one of the big question marks were cable versus telecom, and it was cable modems versus DSL. And the DSL companies, telecom companies, were telling everybody cable won't work because it can't scale. It's a shared network. And I was one of the largest, this is years ago at a prior firm, I was one of the largest shareholders of Time Warner Cable and Comcast, because I had a view from an understanding of technology that cable can not only provide a very capital efficient method to building out bandwidth, I knew that video over the internet was going to become a thing. And when it became a thing, it's going to drive usage rates that DSL couldn't scale. In fact, I wrote something called DSL, stood for didn't solve last mile. I don't know, I threw an extra M in there. But But basically, cable won. They went from 30% market share to a very high market share today nationwide because of the fact they're able to scale these networks very capital efficiently. Well, here we are lots of years later, and they are now the incumbent. DSL has lost. There's been lots of fits and starts on fiber to the home deployments. It's very expensive, very time consuming. But one thing that the industry's never really contemplated was the ability to provide broadband services competing with the likes of Comcast and Charter, utilizing mobile spectrum. In other words, over wireless. This call actually, Kieran, is going over T-Mobile's fixed wireless product. In fact, my entire office runs on it. Our office is about 8 people. It all runs on fixed wireless, including a TV that's streamed all day long with CNBC over HD networks or HD quality product.
So is your point that the bandwidth now for something like fixed wireless is actually more adequate than people think or understand?
Well, there's 2 elements of it. One is how much bandwidth do we actually need? People always think you need more. And the second one is how much bandwidth is actually being provided to you. So we're getting about 200 megs down and about 100 up. We're using this T-Mobile product. We've had it for about 18 months now. It's been fantastic. And the reason why it works today versus 2 years ago, and why as I wrote in one of my quarterly letters, every 2 years, investors looked up, analyzed fixed wireless, and put their heads back down and said, nope, not going to work. The reason why it changed is because under Ajit Pai, FCC leadership several years back, they sold an enormous amount of spectrum from the FCC. Actually, I participated privately and bought spectrum in that same context. But there's spectrum being sold in mass to both to the wireless operators. I think they spent something in the $90 billion range, plus or minus. That's a big number for spectrum. And the amount of spectrum, it wasn't a 3G, 4G, or 5G thing. It was actually just the amount of spectrum that became available and now it's being deployed. So there's excess capacity to be used for broadband services. And so that's one element. Number one is there's been a boatload of spectrum that's been sold by the government and being deployed by the carriers. T-Mobile is a little different because they actually got a lot of excess spectrum from the Sprint acquisition, which, if you want to go back in history, comes back from the Clearwire that got acquired by Sprint that ended up in T-Mobile's hands. But that spectrum they own, the 2.5 gigahertz, is very valuable and plentiful. So you have Verizon and T-Mobile that have been very aggressive in rolling out fixed wireless because there's an amount of spectrum that's been available. The second element is, well, how much bandwidth do we actually need, right? At some point, they decided that 120 volts in our plugs was the right amount of electricity. At some point, they figured out that 70-ish PSI of water pressure was the right water pressure for our houses. At some point, there's a bandwidth number that's going to be steady state, right? So how much bandwidth do we need? So the most bandwidth intensive thing we can do is watch TV on a big screen. Watching TV on your phone or web cameras, all these things are rounding errors. Surfing the internet, rounding error, texting, emailing, rounding errors. Really what the driver is watching video and HD video in big screens. And so if you think about a 55, 65 inch TV over Netflix, that's 2.75 megs per second. Megs per second. So if I have 100 TVs at my house, I might need a 300 gigabit connection. Might. But cable companies are selling us 200 megabits per second minimums. Charter and Comcast, you can't get lower than 200 megabits. Well, I just told you that Netflix is 2.75. Now, there is problems with Wi-Fi, and Wi-Fi degrades through walls, especially if you live in post-war New York or post-earthquake San Francisco, or even post-war Europe, for that matter. So Wi-Fi does have some degradation, but the idea that we need to continue to have faster and faster speeds is kind of the fallacy. And so is 200 megs from the the fixed wireless operators good enough? Well, I just told you my whole office runs on it. And I also run it at home as well with 2 teenagers that are constantly TikToking. So we just don't need that much bandwidth, and they're plenty available. Now, the argument against fixed wireless by the cable companies is the exact same argument that they've given to the telecom companies years ago. Or the telecom companies gave to the cable companies was it can't scale and it's a shared network. True. But the same ideas poses the same exact issue is you can put fiber deep in the network and share that same amount of bandwidth over less people very capital efficiently. So today, Comcast and Charter are floundering in subscriber additions because of the addition of broadband over fixed wireless, with T-Mobile and Verizon adding almost 1 million subscribers a quarter. It's a pretty big number so quickly. And the reason why they're doing it is because it's cheaper, and people generally hate their cable companies. I mean, for 25 years, I've been right that cable companies have been taking share and raising prices. Well, those prices are things that people remember the most.
So it sounds pretty positive for a consumer in this environment.
I think ultimately we're all going to spend less for broadband services over time.
Wow. It's very cool. And then you throw in a little Starlink and other, oddball call options, and it gets even more interesting.
It's funny with satellite, it's kind of similar to fixed wireless access. Again, the idea of using wireless to provide broadband. But for every 2 years, people look up, analyze Starlink or satellite-based communications, and they put their heads back down and said it's really not going to work. Now, it does work in remote areas. It does work where, there's certain situations where on the battlefield or in very rural areas, it does work. But for everyday broadband in residential, suburban, urban, and even more suburban, rural, Starlink has its place, but I don't think it really has a ubiquitous technology. It's just too expensive.
Right. I mean, I remember Elon Musk called it for his rural broadband via satellite it's better than nothing program, which is probably actually right. So,
I mean, there's also a whole bunch of people that live off the grid for a reason and don't want to be.
That's fair.
I think people forget sometimes about, people that want to live off the grid and people think that, of course, they want to be connected. They don't always want to be connected. Well,
Alan, do you mind switching gears a little bit on your own investment strategy? And because it is a very cool and dynamic, and I understand it takes sort of a tech nerd plus a financial analyst to do what you do. Could you just talk about your strategy and how you implement a low net exposure strategy?
Yeah, so at the end of the day, we're stock pickers. I was at Janus for many years, where I co-ran the GNT team, and we learned how to pick stocks at Janus. I have fond memories there, and I really enjoyed my time there learning how to pick stocks. I then went to Dorsal Capital in the Bay Area, where I learned a lot about how to manage risk. And so marrying the two of investing with the idea of a fundamental stock picker with managing risk is something very attractive to me. And so because what we're doing is investing up and down this very large food chain, like I said earlier, DigitalBridge sits in the middle of this very large universe that we invest in. We're investing up to the customers of our portfolio companies, like the cloud guys and the telecom companies, AT&T, Vodafone, Verizon, et cetera. And then we're investing in the competitors to our DigitalBridge portfolio companies, like the tower companies and the data center companies. And then we invest all the way down the stack, the technology companies that go in the data center or on the tower. So we're talking about companies that are doing like data networking, communications technology, semiconductors, components, even some industrial companies like HVAC companies that sell to the data center. We invest in this company that does ditch digging for the telecom companies. I mean, anything that's in our universe, we have an edge on, and it's a very large universe that's largely less looked at, I should say, than a normal TMT investor. And we're not in the internet. We're not in the internet and software companies where most TMT investors invest. But we are looking at this big, large universe of very different types of companies, but leveraging the insight we get from our private portfolio companies as our own internal expert network. It's actually been super helpful, not for every company in the universe, but it's been really helpful to figure out what is going on from the top down from our portfolio companies to leverage that into picking stocks, both long and short. And so ultimately, we're stock pickers. We pick stocks, but then deploying that in a low net, low factor strategy of being an alpha generator, right? Since our inception, 90% of our performance has been generated from alpha, which I'm pretty proud of, right? And because of that, it's because of the information edge that I think we get from our private portfolio companies. But on top of that, it's investing in this way of these interconnected companies up and down the food chain. One person's revenue is another person's CapEx. I said earlier about the semiconductor guy is not talking to the data center guy, but we are, because that's how we think about things. I don't think in Git codes or silos. I think of things in terms of food chains, top of the food chain, middle of the food chain, and bottom of the food chain. I think that's a different way to look at it and not to get caught up in Git codes.
It just made me think, I didn't prepare you for this, but are there times too in your space, because it's so interconnected and the CapEx is so huge that there are times that a very big winner will emerge, or sometimes you'll get sort of like everybody loses, right? Like, like if revenues go down, if churn increases, right? Does that happen from time to time?
I call them shiny pennies, right? Like, we're not quarterly investors or long-term investors with low turnover, but we find shiny pennies along the way where, there's many, many times over my history and career that I've seen AT&T slow down and speed up and slow down and speed up and slow down and speed up, where, you can take advantage of that, both on long sides and short sides. And so that's been, figuring out AT&T spending pattern has been, one of my one of my games of chance. But it's been super fun to do because, again, people that usually look at some of these suppliers to AT&T don't also cover AT&T, right? That's kind of the secret sauce of what we're doing is, again, one person's revenue is another person's CapEx, and understanding you can't invest. I don't understand even how to invest in software because I can't count widgets up and down the food chain.
I understand. And maybe actually, you're out in Denver, and I can't think of a city more geared toward telecom in the United States, more so than Denver. I mean, is it an advantage in some ways?
I would say that there's two things. One, when I first moved out here, I've been here for a long time now. I can't believe how long I've been here. But when I first moved out here, it's definitely the home of cable, and it was the home of telecom. And going back to my nerdisms, one of the reasons why is because Denver has the mountains, right? We're flat, and Denver just to the west of these big mountains. And they built these big sonnet rings of optical fiber where Denver was a big hub of that before they went over the mountains to Salt Lake City and around south to Albuquerque and across to LA. So you had these big circles of sonnet rings, and Denver was that like linchpin between the east and the west because of the mountains. So there is a lot of telecom here, a lot of cable here. We know a lot of people here just from osmosis in the industry. That's been super helpful. Actually, two of our largest portfolio companies, both Zayo and Vantage Data Centers, are both based here as well. Just have, both coincidentally. But there's definitely advantage to being in Denver. The other advantage, which I think is even better, is the fact that I'm not in the same circles as New York and other financial centers where people are just talking too much and there's too much groupthink, idea dinners, and all these things I just don't participate in because I don't want to get caught in crowding. And I think because of being in New York and other, Boston and other circles, you get so many people that are just always talking stocks and always talking ideas where you get too much crowding.
That's a fair point. You also have a proud son of Connecticut, John Malone, who one of the legends in your industry, who built Telecommunications Inc. So
if I can squint hard from here, I can see the Liberty headquarters.
It's I think your strategy is incredibly interesting. I mean, just maybe riffing on futurism for a sec. I also didn't prepare you for this, but I'd love to hear where do you think we are in 5 years? I mean, there's going to be a lot of CapEx. There's a lot of things in the air. There's a lot of things. You hear about low Earth orbit. You heard about things way up in the sky, underground. Where do you think we are in terms of telecom and chips and AI, and when you pull it together for your universe?
It's a great question because I do think in long-term increments, and we spend a lot of time here. I think ultimately, look, these companies, Google, Amazon, Microsoft, et cetera, can't just keep throwing the same amount of dollars at NVIDIA and be successful. They have to lower the cost. It's just too expensive. And so this is why they're designing their own chips, right? And looking at AMD, looking at others. And so I think one is that you might see more vertical integration by Microsoft, Amazon, Google, the guys that have the scale, number one. So I think you might have them either using, maybe even Intel, maybe they can figure it out. But Intel, AMD, their own internal design chipsets. That's one thing. An element is more vertically integrated, perhaps, at least in the next 3 years, maybe not 5 years. The second thing is, and this is, one of the things that we're not just investing in NVIDIA. We actually haven't had a position in NVIDIA all year long. But we have had lots of positions that have taken advantage of the same structure and strategy of the data centers. In other words, things that go in the data center, not just NVIDIA chipsets. There's companies like Vertiv that make HVAC equipment for the data centers. So as you're building, constructing data centers, you need to cool them. Things like Arista, that is a data networking company that sells to the cloud guys. I do think that generally speaking, the cloud companies are going to get bigger and bigger. That's not a surprise. It's not something that's revolutionary. But I think over time, it does worry me the power they will have, right? The AT&Ts of the world, the Verizons of the world, they should have been the cloud companies. They missed the pooch years ago. And so I worry that these telecom companies, I don't worry about them, but these telecom companies are really becoming access companies. That last mile, either wireless or wireline, is going to be the access point onto the network. But as soon as you're on that network, you're gone. You're onto the cloud network of Equinix, or that provides interconnection for Amazon, Google, Facebook, whoever. And so I feel like the telecom company is going to continue to get mitigated over a long period of time. Yeah, they'll still charge us money for access. That's not going to change. But at the same time, I do believe that there's the cloud companies will continue to get bigger, and that scares me. That scares me in a lot of ways. One, the customer concentration that a lot of these semiconductors are going to have, just like Apple became such a big part of many companies' revenue, it got scary, right? Because some companies have 30% of their revenue in Apple. That's not a great thing. I feel like the same thing is happening on the chip side for data centers, where data centers are going to continue to grow, and that worries me. And then on the last side is on the data centers themselves. Over the next 3 years, I told you we have pretty good visibility that these data centers and the growth in data centers, construction, building, and delivering is in a rampant pace. I mean, the amount of CapEx that our portfolio companies are spending is out of control. But there's a return on the other side of it. I do worry about, we're signing these 7 to 10 year deals with Microsoft and Amazon and others. Well, what happens after that 7 to 10 year period and these deals come up for renewal? Are we going to be able to charge Amazon more rent per square foot, lower rent per square foot? That's actually what keeps me up at night for data center companies in general, is that can they actually, with the high customer concentration that we're seeing with the bigger guys getting bigger, the customers getting bigger, can there be a return at the end of the day if we're underwriting these large scale projects with a certain amount of return profile? Can we maintain that return profile if they say, hey, you know what? We want to pay 20% less for that same space and power?
Well, we're going to have to leave it there, Alan. We could talk to you for an hour on this stuff. I think it's fascinating, and I'd love to revisit with you in about a year and see if you're right about some of the things you said. But I think it's just a fascinating area, so thank you.
Kieran, I got to tell you, I love this stuff. I literally love talking about this stuff anytime, any place, anywhere.
That's awesome. Okay, well, appreciate it very much. Take care. Thanks.
Thank you for listening to the Thematic Investors Podcast, powered by Vidrio Financial. With Vidrio Financial, asset managers, endowments and foundations, pensions, family offices, insurance plans, and sovereign wealth funds can cut through the complexity of asset allocation to reduce costs, mitigate portfolio risk, optimize compliance controls, and improve performance analytics. Interested to learn more? Contact us today at vidrio.com. That's VIDRIO.com. The information covered and posted represents the views and opinions of the guest and does not necessarily represent the views or opinions of Vidrio Financial and or our host, Kieran Cavanna. The content has been made available for informational and educational purposes only. The content is not intended to be a substitute for professional investing advice. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding investment planning.